talk about what's going on in the implied volatility space around FOMC, which happened earlier today. So what you see here is the VIX in orange, and then the S&P is in the candles here. And what was interesting is Friday we had this huge spike in the VIX, right? This is the kind of the conflict bit, I call it. You know, war is unfortunately breaking out in the Middle East, and so into the weekends the VIX has been bid up, and we've done a bunch of videos and conversations about this. You can find those on our channel. And so what happens is, as vol gets bid, the S&P or equity market tends to sell off, and this is kind of some Vana pressure. And then what happens on Monday, and this is Monday, you can see here, that pressure is released and the equity market rallies. So this is like a real-time kind of example of the impact of Vana, right? Puts get bid. As puts get bid, the price of puts increase, hedging flows associated with puts increase, that pushes the market down, and then all that pressure again is unwound. Now, it was interesting the last couple of days and coming into FOMC is what you can see here is the VIX has been just crushed since Monday. I thought vol would kind of not sell off hard into Tuesday and would wait for kind of Powell to release, and what's happened is vol just got kind of smoked and pushed down into Powell, and what you can see here is the equity market S&P here rallied right into FOMC. So what this means is that if you look from Friday's close to Wednesday's close, that's tonight, we're up 3% in the S&P. It's quite a move, right? And the VIX has gone from all the way up here from roughly 22 down to about 16 and a half. So if you think about Vana as a rally mechanism, you know, how much more is left in the tank now, right, with vol coming down? Well, for that, what we look at is this chart, which is called the S&P Variance, and this comes from Euan Sinclair's fantastic book, or one of his fantastic books. The name escapes me. I'll put it in the comment section, or in the description, excuse me. But what you see here is the difference essentially between the VIX and 1 month S&P realized volatility. So how much has the market been moving? How much has the S&P been moving versus what the VIX is pricing? And what you can see here is that when the VIX is elevated over realized volatility, we see that as a healthy volatility premium. So on Friday, for example, you almost touched this blue line. This blue line is telling us that the market is worried about events, worried about interest rates, worried about war. Implied volatility is bid up, right? The VIX is bid up relative to how much the market's moving. So what's happened now is that premium has collapsed back to its mean. So if you were going to say, is the VIX fairly valued or expensive or cheap, you know, if you want to use that type of semantics around it, you could say it's probably fairly valued at this point. As you can see with this data point here, it's come back down to the mean. So if you just want to say, hey, look, we crush vol and we get a Vana rally, how much, you know, fuel is that good for? Well, the fuel's almost used up. Now, if you want to take that one step deeper, if we look at our Vana model, and what our Vana model does is it moves around implied volatility to estimate when and where the impact of shrinking implied vol will sputter out. You look at this purple line here. This is a delta estimate of how much dealers have to buy and sell for a given price in the S&P 500, and we adjust the implied vol for that. So what happens is, obviously, as the market crashes, implied vol goes up, the VIX spikes and increases, in theory, the amount that has to be hedged by dealers. And so what you can see in this model is it troughs or bottoms out around 42.65, let's call it. And what that basically tells us is that if you're going to smush vol down, the maximum impact of that feeds into this 42.65 area. So if you're going to kind of extract the Vana fuel that exists right here, right now, you know, 42.65 is kind of where that taps out a little bit. And again, you know, looking at the variance model, you say, okay, there's maybe a little bit of juice left to squeeze. And if you look at where the S&P closed, we're at 42.40. You say, okay, there's maybe a little bit of juice left to squeeze. So if you look at what happened today, you know, you can see here Powell comes out and vol takes its final, or the VIX, excuse me, takes its last major leg down. So what does that mean for longer dated options if you kind of wanted to take it one step further? Well, what we did here is we loaded up the skew for December OPEX, which is about 45 days from expiration. So the gray line here, and this is, again, one of the interesting parts I thought of what's happening around the market now, is the gray line is from Friday, which was obviously very bid up, right? And then into Tuesday, which is the yellow line, you can see there's a very big gap, right? They really crushed vol here into yesterday, and then the difference between yesterday and then today obviously is quite a bit smaller, right? So yes, the gap from Friday is really really dropped a lot, but Powell didn't seem to add a whole lot of extra kind of vol smush in there, essentially is what the technical term is, I guess. So, look, the issue here for equity bulls is that we were looking for implied volatility to come down as a major driver of equity markets, right? And the reason is because as put values go down, equity markets can rally. And that's what we essentially classify as a short covering rally. So if we look at this and you say, what is this? Well, this is short covering, right? This is put values getting crushed, implied vol coming in. Generally, this would happen after Powell, right? You have some event vol that would come down, so I think there's still a little bit of a kicker here. But this fuel here is rally fuel. It's short covering fuel. The problem is for traders is that you need to have some reason now. You need long buyers, right? Long call buyers, some other type of long entity or flow to come into the market to now take the baton. So we've pulled this rally together off of essentially short covering through the volatility crush. This is Vana fuel boosting the market up. And now we need some other long buyer to take the baton. I still think here in the very short term, we closed right around 42.40, let's call it. I still think in the short term, we can get a little more punch in the next couple sessions to get up into 4,300, but we really need something else to help propel us. Now, if realized vol continues to come down, that means that VIX and vol can continue to come down. So if we look here at realized vol in the S&P 500, and we kind of zoom in on this thing a little bit, what we see in green here is 1 month realized vol, and that's at about 13 and a half, excuse me. So this can come, I think, quickly back down, let's say into maybe the 10s or something like that. So if you add in that 3-point VIX premium, you say, okay, VIX 13-ish, 14-ish maybe would be our best case scenario in this situation. If that happens, that's Vana fuel, right? Helps push the market up. But what we really need to see is, again, these long call buyers come into the market. And, when you look at what was taking place today, it doesn't really sync with a whole lot of long call buyers. So one example of this is the Mag 7 indicator. This is our hero indicator. It measures real-time options flows for today. You can look at this chart and see, without looking at the time series and seeing, okay, this is when Powell kind of gave the all clear in a way, or at least wasn't overtly hawkish, I would argue. And the reason I argue that is because the market rallied. If Powell gave an unexpected hawkish surprise, equities would likely trade lower. And you can see this purple line tells us that calls are being bought, puts are being sold, and up goes the market. Very interesting to see here that even though equities sold off here, the Mag 7s didn't drop. People didn't buy puts into that decline. So what kind of flow was this? Let's drill down one level. Okay, here we see two types of flow. In orange is calls, in blue is in puts. Okay, a fair amount of call buying, about $1 billion worth of deltas. And then there was about $500 million worth of puts being sold. So, if you were going to say, look, I want the rally to extend, you want to see long dated call buyers come in because those are people that are betting on the Mag 7s going up over time, right? And same thing with selling puts. There's a lot of earnings in these names over the last couple of weeks. And so maybe there's a lot of puts being closed into this. A lot of them are also at relative lows. So maybe there's also some put sellers, some shorting in there. Let's break it down one further. And this is what I find to be a smidge concerning. If you look at what we see here, we see about half of the order flow in the Mag 7s is 0 DTE. And so this green line is 0 DTE calls. The orange line is all expiration. So the fact that the spread between these two lines, the orange and the green, is pretty consistent throughout the day. This tells me that a lot of the flow here was 0 DTE call buyers, about half of it. And then the same thing you could argue for put selling. About 240 million of the 480 million of total put sales on the day was 0 DTE. So that basically says that half of the flow in the Mag 7s today, as we can see here, almost exactly half, was kind of 0 DTE adjustments and noise. Yes, it looks good because there's some call buying in there. And you can see down in this indicator, it's all the way to the right. So this is a record amount of Mag 7 flow, but a lot of it is 0 DTE. So, look, it starts off as bullish. In our founder's note, we very clearly laid this out. We said, look, if we close above 4,200, we think we're getting a 4,300 test. We stick with that. But this idea that this is a given that we're going to rally to all-time highs, we're not quite ready to jump on that bandwagon yet. We want to see some longer dated call buyers come in. We want to see vol continued to come down, and that would help to fuel us back. We think 4,500, this general 4,500 area, is a reasonable upside target if we continue to rally. Don't think we get a whole lot over that based on current call positioning, but this is an active market. So at any rate, hope this vol breakdown helps. Hope this helps to put some of the flows into context. A short-term rally seems to be, the wind is at our back right now, extending it into a year-end record rally. We want to see those calls come in. We want to see call walls roll up, put walls roll up, and more long-dated call flow enter into the markets. So I hope you found this helpful. If you are interested in reading our daily notes, just head over to SpotGamma.com, and then you can click subscribe now at the top. Hit subscribe now. You get a free 7-day trial to kick the tires, see our daily notes, see all of our indicators, join our Discord, and hopefully we can help guide you through the rest of this year.